Joining us now is Gautam Trivedi, who's a co-founder and managing partner at Nepean Capital. Gautam, thanks so much for taking the time and for speaking to NDTV Profit. Always a pleasure speaking with you. In the past, you've spoken about reasons why global investors are doing what they're doing in India, the way that they're viewing India. And I'm curious, we're speaking on a day when Tata Consultancy Services, or a few days after, they've announced a pretty large cut in the workforce, and that just sets the tone for the IT pack as a whole this morning. It's a sector that a lot of foreign institutional investors look at very closely. How do you view this? Because the jury's out. Is it near-term negative but long-term positive? Is it simply a replacement of high-cost, slightly redundant workforce, or is it telling you that the demand scenario is looking bleak?
It's a good question, and I think that's something which a lot of people have been debating for, especially since I guess the last 4 to 5 months with the advent of AI. And every week you get a new update on what AI is going to do, can do, will do, and 5 years from now it's going to get even smarter. So I think these are real issues that the Indian IT sector is, I guess, starting to grapple with. And today, as in this morning's headline, was literally the first sign of what I think is potentially coming, i.e. more layoffs. And that has, I think, as I heard you guys on earlier, going to have major ramifications across the Indian economy, across urban consumption. I don't want to sound doomsday, but this is a reality that we have to wake up to. Maybe there's a lot of reskilling that needs to be done. And I did like what Salil Parekh said in his previous, not the last quarter, but the previous quarter's conference call, where he said the big opportunity for Indian IT potentially is AI enablement of companies globally. So that I think could be also a big opportunity, but I guess maybe they don't need so many people anymore. So that this I think is a new reality that the Indian IT sector has to wake up to.
Gautam, good morning, Neeraj here. Lovely talking to you as always. There is this chatter around how the US earnings growth is looking fairly strong. I mean, one of the articles quoted Mike Wilson of Morgan Stanley saying that the earnings number is looking much better. And therefore, if the US markets stay buoyant, if you will, despite the valuations that it is trading at, does it give a bit of a support to markets like India, or could the US do its own course and other markets may suffer?
So let's look at the numbers this year, right? If that was indeed the case, foreigners year to date have sold $9.6 billion out of India. Now, the India growth story, yes, has slowed down a fair bit, but the fact is the future still remains extremely bright. So you have at one breath a sovereign wealth fund, as you've seen in this morning's papers, talking about making a big investment in a housing finance company. And at the same time, you have pension funds looking at deploying more money. So you've got that. But then if you look at the overall active investment community, which is within the FI side, I think that is really the question that people are asking. Why is it that they are net sellers? And there are a bunch of reasons for that. I think one of the prime reasons, if you look at it, is the fact that the Indian market, again, it's always been expensive, but today it's at the same valuation as the S&P 500. In fact, the S&P 500 is at a bit of a discount to the Nifty 50. So my view really is that foreigners, if you're sitting in the United States making a capital allocation, global allocation to different geographies, would you put money incrementally in India, or would you incrementally look at other markets like China, Korea, Taiwan, which, by the way, have 13 to 14% earnings growth this year? So we are still struggling with high single-digit earnings growth, whereas these markets are forecasted to have anywhere from 13 to 14% earnings growth. So I think these are real issues and real reasons why I think foreigners have been actually not putting incrementally new money into the market. And also, if you look at the Buffett indicator, very clearly market cap to GDP is at a record high. So I think these are issues we grapple with. Of course, domestic investors are fueling all of this, and they seem to be completely oblivious to either a Buffett indicator or any sort of geopolitical issues.
Gautam, hi, good morning. Tamanna here as well. I'm wondering what's going to be the trigger to sort of change the outlook. Will an India-US deal do the trick, or at the end of the day, what we're seeing in terms of numbers and corporate results is truly not enthusing the street. And this is something Goldman Sachs has talked about as well today.
Yeah, so there are two parts of this. One is the fundamental part which you're referring to, and the second is the fund flows. So let's look at the second part first. This is really a three-legged stool. So you've got, as we discussed, the FI community, which is negative 9.6 billion of selling, domestic institutional investors, i.e. mutual funds, and insurance companies have plowed in about 46 billion year to date. So that's, again, a record number. But if you minus the two, you still find that the market's only up about 6.5% year to date in local currency terms. Why is that the case? Because the third leg of the stool really is the domestic retail investor, HNIs, family offices, etc., who are not counted in the DII numbers. And if you look at them, they've actually been net selling in the market. So you got the FIs. So of the three, two are net sellers, and the only positive really out there is the domestic DII flows. So I don't see the market actually having a major correction until we don't have DII slowing down. Now, when you look at the DII flows or the domestic retail investor flows, I was going through something called the Market Pulse, which is a NSE product. The chief economist, Tirthankar Patnaik, puts it out every month. It's available for free, by the way, on the internet. It's got a ton of data. And I was browsing through this, and to my surprise, I found the top 5 cities in India account for almost 50% of the 11.3 crore unique investors. So it's only 5 cities, 5 states, beg your pardon, 5 states that account for as much as 50%. So the penetration of the equity culture in our country has not even reached the halfway mark. That's the point I'm trying to make. So I don't see domestic flows slowing down anytime soon. Plus, of course, if you look at the returns you're getting in a fixed deposit, my HDFC Bank is offering me, my HDFC Bank account manager is offering me a 1-year tenor at 6.25%, and this is pre-tax. Savings rate right now are as low as 2.5%, again pre-tax. So where else do you incrementally put your money to work?
Well, there's a bit of a recovery from the lows, so that is also very, very interesting. Gautam, people pick and choose, right? I mean, my question is, are you batting for earning? Are you picking sectors or themes, or even if you're bottom up, companies which have strong earnings growth, never mind the valuations, or are you hunting for value currently?
I think value is difficult in this market, as it's been for the past at least 24 months. But having said that, we run screens every week to see what's out there that's not really worked. So the recent screen that we ran of the top 1,200 stocks by market cap, we discovered that about almost 890 to be precise, that many number of stocks were up 25% or more from the 52-week lows. That means 300 stocks are still somewhere, that haven't really moved. At the same time, if you look at stocks like a Hindustan Lever, for example, it's done nothing over a 3-year period. Dabur, Vedant Fashions, Relaxo. So, Bata, Campus Shoes. I mean, I'm not saying these are necessarily buys today, but I'm saying there are a whole bunch of stocks which are actually good quality companies, but haven't moved for a variety of reasons. So you might find some value there, but I think otherwise you have to ride the flow that's coming in terms of absolute money power.
Spoke about IT, but incidentally, this morning we're also focusing on the banking and financial space. On Friday, you saw a pretty big drop in Bajaj Finance. This morning, you're seeing Kotak Mahindra Bank taking on the chin because a lot of people looking at an ROA number, return on assets number that's fallen below 2%. I think a few people can't remember the last time it happened. And you have a very substantial drop in the net interest margin. So there are concerns about some aspects of credit or asset quality. But having said that, the multiples, and a lot of people are looking at the price to book multiples and saying, hey, you know what? Kotak Mahindra Bank is cheaper than it has been at any point over the last 5 years. Is this an opportunity to accumulate? So would you agree?
Yeah, I don't want to get specific.
No, I take that. Yeah. But then large banks is what I'll ask you about.
Yeah, I think to some extent you could be right. But the stress, if you follow Bajaj Finance's commentary, and the whole street follows that, we do as well. And if you look at some of the comments that they've made, 17 industries that they track, 13 are showing slowdown, 3 are showing contraction. It's a virtually a perfect. I'm reading this right off their commentary. So it's virtually a perfect storm in a way, and it's come too suddenly. So I think these are obviously the words to think about coming from India's largest NBFC. And I think MSME clearly is hurting, as is the microfinance sector. So there are certain pockets that are, and also personal loans, I think. So there are certain pockets that are clearly hurting. At the same time, when you look at private sector credit growth, that's also not picking up. So there are certain challenges, but when you talk about valuations like that, I do agree that some of these things could be great from a long-term perspective.
Okay, thank you so much, Gautam, for speaking with us.
Thank you.